You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The futures markets can be downright scary. Limit up, limit down. What the heck is RBOB anyway? Are they going to dump a truckload of soybeans on your front lawn if you click the wrong button? Come to think of it, maybe you should just stick to your comfort zone. Or you can break out of it with the Futures Rundown. The Futures Rundown is here to help you make sense of these scary markets. We'll analyze all the top futures trading activity, explore the ins and outs of your favorite products, explain exactly how futures work, and hear from leading experts in the futures markets. We'll even tackle all of your wildest futures trading questions. If it involves futures, then you'll hear about it on the Futures Rundown. Old trading walks into a bar. New trading raises it. That's Tasty Trade. Keep focused with news feeds that matter. See opportunity differently in analysis mode. Chart your heart out with over 300 indicators. Plus, you can get low pricing, lots of education, and a support team that really gets how traders trade. It's no wonder Investopedia named Tasty Trade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/podcasts and see for yourself. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. And now, it's time to break into the futures markets. It's time for the Futures Rundown.
All right, everybody, that music means we are back. It is time to dive into the futures markets. And man, those waters are choppy. Those waters are rough. A lot to get to on the show this week. My name, of course, Mark Longo from the Options Insider Radio Network. Your home now for, 19 plus years of options podcast goodness. Of course, a lot of futures editions coming into that, including this show a little over a year ago now. So all sorts of fun going on out there on the old network. Yet another reason why you should be subscribed to the full network wherever you find your favorite podcast. And of course, if you want to join us for some awesome live trading sessions like we did yesterday, other exclusives, about a dozen live streams every week, options oddities every Friday, vol death matches, and even awesome giveaways. Congrats to our member Mackenzie, who won just on the last show, just on Options Bootcamp. She won the February Pro Trading Crate. Want to get your name in the hat for March? theoptionsinsider.com/pro is the place to go. But obviously, coming into this week, all eyes were on energy, all eyes were on crude. So we have to head there first as we open up the futures hot seat.
Let's learn from the market movers, size traders, and leading minds in the futures markets. It's time to roll out the futures hot seat.
Welcome to the Futures Hot Seat, the portion of the show where we dive deep into a particular market or product. I think anyone out there can guess this week that all eyes are on all things crude. I wonder why that might be, listeners. And joining us in the hot seat this week to help us tackle this wild market is a newcomer to the program and indeed to the network. He is Brian Pieri, the founder of Energy Rogue. Brian, welcome to the Futures Rundown program.
Mark, thanks for having me. I appreciate it. I love the show, and I'm happy to be here.
Well, I'm glad you're enjoying the show out there, Brian. It is a newer edition, but we do love sinking our teeth into the world of futures. That said, this is your first time joining us here on the program, so why don't we start there? Why don't you give our audience a bit of an overview of your background in the world of futures, as well as what it is you do over there at Energy Rogue?
Okay, great. Well, I started the energy commodity trading adventure back in the mid 1990s before there were electronic trading platforms, before there was E-Trade or anything where you could click some buttons and buy or sell online. You actually physically had to call somebody in a pit and buy or sell the futures contract. So I spent about 2.5 decades on the physical and financial trading side of the business for crude oil, for natural gas liquids, refined products, and each one has their own nuances. And after working at shops as large as Chevron, as large as Sumitomo, as large as Louis Dreyfus, I realized that there was a lot of institutional knowledge of supply, demand, the fundamentals of the market that was really missing from the technicals of the market for traders. So I launched a product to serve that market with energyrogue.com. And we provide a subscription service that gives you all the facts of everything that you want to understand about the supply, demand, imports, exports, storage stocks. And on weeks like this, that becomes really, really important to understand.
Let's get to all of that fun now, because obviously it has been an absolutely wild week from a geopolitical perspective and obviously from a crude oil perspective. And this is obviously not a shock to a lot of people. We were talking about this on our This Week in Futures Options program last week, and even in the weeks before that on the Futures Rundown. The prospect for upside in products like WTI and Brent on the expanding war or conflict over there in the Middle East. That, of course, did happen over the weekend. Last week we were talking about, I think there were May 85s in WTI going up on CME. Those are looking a lot better this week than they were this time a week ago out there. But Brian, let's start there. For a lot of our listeners who are trying to come to grips with this insane move we're seeing out here in crude oil this week, walk us through some of what you're seeing out there, as well as obviously these new escalations like Iran closing the Straits of Hormuz, shutting off a lot of the global crude supply, how that's impacting what we're seeing out there in the markets.
Okay, great. And I actually was on a podcast out of Dubai earlier, well, at 12 a.m. our time, but it was tomorrow at that time. But what the strait is not formally closed. There are a few ships that have attempted, and some have made it through the Strait of Hormuz. It's more a risk game.
They're just blowing up most of them.
Well, here's what's happened is a lot of people, when we look at the global crude supply and demand, you have roughly 104 million barrels a day. Of 20 to 25 of it flows through the Strait of Hormuz. So when you start there, this is a massive, massive portion of the market, and that's the reason Strait of Hormuz is one of the most critical choke points to look at. Now, Iran, with its positioning right there, can create some disruption. There has been 3 tankers hit, and the strait does have a lot of parked tankers on either side. There is a lot of storage balance in the market that can absorb some of the dislocations of too much supply upstream of the Strait of Hormuz and not enough supply on the downstream side. For example, China has been stockpiling crude oil for the last year and building because I think they probably saw this coming. So this was something that was well telegraphed. Mark, you mentioned that y'all were talking about it last week. This was something that was probably objectively viewed upon as a likely outcome. Now, when, how, where those things were going to change. But what I would look at is within a week, this could get very tricky very quick. And obviously, most people in the futures trading market are looking at the difference from Friday's crude oil trade to Monday and to today. But what I would urge you to do is actually take a look at maybe a month ago and see that there's already been some risk premium that was building the price. And that's part of the reason we're quote unquote only up, say 10%, 10 to 15% is because there was already some geopolitical premium being built into the trading price. And you've seen that on crude oil, you've seen it on heating oil or ultra low sulfur diesel, you've seen it on Brent, gasoline. But I would say out of the products mix, when you're looking at heating oil versus gasoline, one thing to consider is that distillates are in a much more bullish stance fundamentally than gasoline. Gasoline is very well supplied across the board. So, and that has to do with what type of crude we are throwing through refineries. So I threw a lot at you. I'm not sure if I hit the mark.
No, that was great. And you're right. We have seen an interesting trajectory in WTI, for example. Listeners, we kicked off the year in the mid to high 50 handles out there in WTI. So obviously a far away from where we are right now. But even by the end of January, as you pointed out, Tim, we started to see some of risk being priced in out there. We were up to about the mid 60 handle by then, right about a 65 or so in WTI. Then we kind of vacillated around the 60 handles until, again, all this news really started popping off in earnest again. And now, of course, we find ourselves rather close to a 75, 74 and a half in WTI right now. So a good 20 handles has been added on over the course of this year so far, with 10 of that really coming just on the heels of this big move out here in the weekend. But you mentioned something else out there, which is interesting. Everyone's fixated on crude for obvious reasons. It's the headline maker out there, and it is the raw product that is being shipped out there. But we also have, of course, gas, which you mentioned might have some other supplies that could offset some of that. We have distillates. So we see, even though crude may be having problems getting the supply out, we do see disparate moves in the different products as a result. You know, you name it, heating oil, all kinds of products out there. LNG is being impacted by this as well, which is a frequent topic of discussion here on the network. So you mentioned kind of the oversupply of gas, keeping things a little bit manageable. Are you seeing any other interesting nuances to how the broad spectrum of the energy products are reacting, not just the 800-pound gorilla, which is crude?
So you asked about a good one and kind of touched on a key one, which is LNG. When you look at a lot of people look at natural gas on Henry Hub, the NYMEX Henry Hub, and NYMEX Henry Hub is located in Louisiana, and that is, you got to bear in mind, if you go back 10 years ago, we did not export natural gas. We did not export LNG. We did not export via pipeline, except for a little bit to Mexico. We now export 25% of our supply that we produce in the United States. That means that there's an attachment to foreign pricing of those molecules. When you look at TTF and JKM, they have almost doubled in the last week. Now, for obvious reasons, because Qatar is shut down right now. So that is 20 to 30% of the global LNG supply side. But there's a key difference here, and this is part of the reason we focus on the fundamentals. Theoretically, us exporting 25%, you would see Henry Hub participate with that, with the exception we are currently already exporting everything that we can. So there's not excess export capacity to meet incremental demand. So it's really irrelevant. There's not more molecules to push that way because we're exporting as much as possible. So from a fundamental supply and demand standpoint, it doesn't really matter. If it's higher priced over there, you can't get there from here. So so that's what I'm seeing on the natural gas side. However, I would say we've had an unseasonably warm into winter, and that's part of the reason natural gas is a little depressed. But I see this as a low point for the rest of the year. I think we're going to be building back because the supply-demand balance is a lot tighter than people imagine. People believe it's pretty well supplied. There's going to be some challenges on that side.
The nat gas trade this year has been fascinating. We can have you back to a whole conversation on that. This year alone, it played out in the most cliche way imaginable. You bought it going into the cold weeks. You sold it right after. You made a killing. It's not supposed to work that way. It's too obvious, but it worked pretty well this year. But let's talk about how you like to approach these markets here. Obviously, this is the futures show, but we're an options network, so we're open to all of the above out there. When you're looking at playing in the crude space, are you primarily on the futures side? Do you play in the options? What is your vehicle of choice when you're trading out there in the energy space?
Well, with Energy Rogue, we actually focus on physical markets, futures markets, and option markets. So we look at various strategies and we triangulate which strategies are going to be most effective. Prior to the events that have transpired over the last few days, storage spreads or option spreads, calendar spreads were not really prevalent on the curve for crude oil. We have been saying for the last several months that heating oil was set to increase because we saw that the fundamentals were aligned that way, that we're going to produce less distillates, and that has to do with the type of crude that we're producing nowadays, and that we were bullish heating oil, bearish gasoline. So there's spreads between intra products. If you buy one side, sell the other. Now with the lift that we've had in distillates, may have been a little too far too fast on the heating oil side. Crude oil, I really would put in. We're going to have to watch headlines, because if the Strait of Hormuz, now you mentioned it's closed, it's not formally closed, but the U.S. did announce that they will use naval ships to provide escorts. It's easy to say, hard to execute. They're not going to be able to do it. And that is one thing I would watch if the strait is at this reduced capacity. Because, like I said, there's a few ships that are going through, but they're taking a risk, because one of the reasons that this is important, insurance companies have canceled contracts for any ship traveling through the Strait of Hormuz. What that means, the average ship is worth 60 to 70 to 80 million dollars. So you're taking a very large credit risk when you don't have insurance covering 60 to 80 million dollars. So you have very large institutional traders that have large amounts of dollars literally sitting in a boat on the ocean waiting to be monetized.
We did announce earlier today that we are going to attempt to escort some of these ships through the strait. You're right. Maybe a little easier said than done. We are taking out their Navy, so I suppose that is one thing that should maybe facilitate that, but they also have other ways of reaching out to ships in the strait that don't involve engaging with our carriers and our battle groups and all of that interesting stuff out there. Speaking of interesting stuff, we touched on a bunch of different products. This is obviously an international conflict, so the lens for that is typically through Brent. That is the more international flavor of crude. Here in the U.S., here on the network, we tend to focus more on WTI. It's the more liquid, pun intended, product here in the U.S. It trades pretty readily over there at CME. As you're looking at the two right now, have you noticed any interesting nuances between the two? Are you maybe preferring Brent right now because of the nature of this crisis, or are you trading them both interchangeably?
So normally when you have extreme price escalation on two correlated products like Brent and WTI, normally you will see the valuation or the spread between both of them expand. So when prices rise, you normally see an expansion of that spread. I've seen that spread stay pretty close to historical averages. Eh, So there might be a play there to where you can see some expansion or compression. Honestly, I think from a purely fundamental, if you take out the geopolitics here, crude market in 2026 is set to be very well supplied. IEA projected prior to this that we would be 3.7 million barrels a day oversupplied, which is a massive, massive amount. 1 million barrels a day of oversupply means that we're at $40 crude. 3.7, we're way overpriced. But what I would say is we've had some surprising demand numbers. So I see both WTI and Brent settling back down into the 60s. As a matter of fact, if you look at the 2027 strip, you'll see Brent in the high 60s and WTI in the low 60s, holding about a $4 to $5 spread. I would expect that $4 to $5 spread to contract probably to 3.
You mentioned there's some slack in the system right now in terms of oversupply. That is an interesting point. Maybe one of the reasons why we're seeing this response a little bit muted. I mean, it's still a 10-handle move across the board, but maybe some folks were expecting even more of a shock to the system. Of course, we're also seeing some other surprising developments in this conflict where we're seeing Iran now attacking its neighbors with drone attacks, things that maybe in the past they would have been reluctant to join in with these attacks and maybe also reluctant to dial up the spigots in OPEC. Now all of a sudden they're being attacked, so maybe they're a little bit more willing to do that. So does that factor into your analysis as well? Do you expect them to maybe turn up the spigot if we do get more shocks, if the traffic flow is narrowed down there, and that might impact and really mute some of the upside we might see going forward?
So I do get asked for a lot of international perspective from various countries in the Middle East and Europe, and I often get asked a lot of political questions. And I usually start with, when I grew up, I didn't want to go into politics, but unfortunately, I chose energy.
It's inescapable when you're talking crude. You know, if you want to get out of politics, then I don't know, maybe livestock.
But what I would say is with all of that, you can now pull back and take a look at the game theory. If you look at Iran's perspective, what is the focus? The focus is not necessarily to punish the neighbors, but to add pressure to get them to align to have US and Israel back off. So it's not so much to attack them to start. If you have two people beating up on you, do you hit a third? I don't think so. That's not a good strategic choice. However, if that third can get those two to back off, maybe so. So that's part of the calculus when you look at this. I think this can get very tenuous very quickly, and I would say from the U.S. perspective, this is probably not the most popular thing to pursue, especially given that there is a linkage in the U.S. A linkage in the U.S. that, well, if oil goes up, everything else is going to get more expensive. We're fresh off of a lot of inflation fears, and now we're just reigniting those. So there's probably going to be a lot of pressure points from a geopolitical perspective, from a political perspective, and a geopolitical perspective. And the world that we understood 5 years ago didn't exist any longer. Alliances are changing, shifting, and as those alliances are changing and shifting, because when we talk about the Strait of Hormuz, historically, if we went back 20 years ago, most of the crude was coming to the Western states, coming to Europe, coming to North America. Now, when you look at it, 80% goes to Asian markets. So when you look at that, it's India, it's China, it's Japan. They're really going to be impacted by this. And add in, not so much attacking the neighbors, as much as oil is exiting, 80% of the region's rice is imported via the Strait of Hormuz. That can't come through. 30% of wheat products get imported, and they don't have a lot of natural farms in the Middle East. So food is going to be a very serious crisis here soon, and potentially like within 2 weeks.
You mentioned politics. It is unavoidable when it comes to talking about all things energy, unfortunately. On the other side of that, OPEC obviously turning up the spigot. Also here in the U.S., we do have the strategic reserves. I don't know why they call them that. They really should be called the political reserves. They seem to be opened whenever it suits political purposes more so than strategic purposes, shall we say. But you're right, price is going to start going up if crude remains elevated. Might be some pressure on the administration to open up the spigot here domestically, take some of that pricing pressure off. Do you think that's another thing that's maybe muting some of this response we're seeing in WTI in particular right now?
Well, I think there's going to be political pressure, and I think that is real, and that pressure is definitely happening from multiple sides. There's political pressure inside of Iran. You know, there are protesters that want a different regime in charge, And so what these pressure points are, I would say if you took this event 10 years ago, we're already 100 to 120. This would be a lightning rod. So oil traders since 2022, the last time that we had some big shocks, because when Russia invaded Ukraine, we had big oil price shocks, natural gas price shocks. Oil traders and futures traders over the last 3 years in particular have gotten to a show me the disruption and I'll respond. So there is some price escalation, but this event would be over 100 almost immediately 10 years ago. Now, oil traders, after seeing Russia, Ukraine, after seeing a lot of conflict in areas that are very impactful from a supply and demand perspective. I mean, when you're talking 20 to 30% of the global energy supply for LNG, for crude oil, if this lasts for a month, the world is going to be in for, I mean, disregard the COVID shocks, supply and demand shocks. This is going to shock things in a lot of different ways. And that's not just going to be on an upside risk. There's going to be some downside too.
Well, speaking of looking ahead, if it lasts for a month right now, how are you positioning over there at Energy Rogue? Are you straight long right now? You mentioned some of the intra-product spreads. Is that how you're shaping up? How are you positioning over there right now going forward?
Well, I'm not a financial advisor. I do not give financial.
It's just two guys talking and a lot of people listening. That's all, Brent.
Just two guys talking. A lot of people listening. I'm my personal opinion is that I'm shorting this. I expect this to reconcile, probably back down by $10 because I think those pressure points will win out. That said, I would probably have a short leash on a stop loss. So the thing is that because if it escalates quick, we could be at 100 in a very short time. So I would have a stop loss, but my personal opinion is I think we're going to drop back down to the mid 60s for WTI and high 60s for Brent.
Interesting. I think that might come as a surprise to some people out there, which is why we do the show at the end of the day. Speaking of doing the show, we have to keep on rolling. We have more products to talk to. Surprisingly, there are other things trading this week, Brian. But before we get there, I see a question coming through from the live chat. Let's just get to it now. They want to know, what does the guest see as being more volatile for the length of this war, nat gas or crude? So where do you see more volatility in the near term here, and I guess for the duration of the conflict?
So for tradable products, if you're talking about natural gas, you're talking about Henry Hub. Henry Hub is kind of insulated from the LNG volatility that we were talking about. TTF and JKM have nearly doubled in a week. Natural gas in the United States or Henry Hub is maybe up 2%, 3%. Like it went up and it came back down because of weather. Weather in the US is very mild. I live in Colorado. I'm in a t-shirt and shorts. So the thing is that t-shirt and shorts during winter, there's not a lot of demand. And a key point on natural gas, if it's nice outside, natural gas prices are not going to be good because natural gas thrives on cold and heat. So between those two, so I would see natural gas from a Henry Hub US perspective as not being really impacted or insulated from this event. This is all going to be around crude oil and heating oil and gasoline. Gasoline is probably the most bearish from a fundamental perspective. Heating oil has one of the biggest impacts because we did just have some strikes on a refinery in Saudi Arabia. That is going to limit some of the diesel and jet fuel. So I can see jet fuel rising. I can see diesel staying elevated. It's already had quite a run because a week ago we were at 250. We're now 3, something like that. So I would say that crude and crude related products are going to be where you're going to see the action on this.
All right. There's a lot more action to come, listeners, as we dive on into the trading pit.
It's time to break down all the action that's lighting up the futures markets this week. What's limit up and what's crashing and burning? Let's find out. It's time to enter the trading pit.
All right, everybody, welcome to the Trading Pit, the portion of the show where we break down what the heck is trading out there in the world of futures this week. And surprisingly, there are some products that don't involve energy that are actually trading this week out here and lighting it up. So I think we'll start there. Most of them are going to the downside this week, so I think we'll start there this week. Number 5 to the downside, listeners, we've got soybean meal coming in off almost 4%, about 3.75%. Number 4 to the downside this week, we're going out to the metals, a rare week where some of the shiny stuff taking a bit of a hiatus. Again, kind of an interesting development we saw early this week as there was just people were liquidating everything, it seemed like yesterday, including the metals, and platinum feeling that yesterday off 7.3%. Lithium coming in at number 3 to the downside this week, listeners, off 8%. We've been talking about this one for a while on the show now. Not the most liquid of products out there, but it has been exhibiting some vol of late. Number 2, maybe a surprise to a lot of folks out there. It's our old pal silver. It's lived many lives just so far this year. It's been a wild year already in silver, just 2 months in. Off nearly 9% this week, 8.8%. And then palladium, the big dog this week, off about 9.2%. I know, Brian, you're hanging your hat out there in all things energy all day, but you must be paying attention to some of the other wild moves. I mean, it's kind of hard to escape the move that's been going on in the metals so far this year, in particular silver. You could write case studies for days, and I'm sure they will, on the move just in the last few months. Anything catching your eye in the markets that are lighting it up to the downside this week, sir?
I would say start looking at currencies. The interrelationship between crude oil and currency has historically been linked because of the petrodollar. That relationship is rapidly changing, and that's my belief or hypothesis is that's part of the reason that you see increased activity in the metals, because people are getting into alternative things other than fiat currencies. So I think hard assets are going to be where volatility is and where opportunity is. So looking at DXY and VIX are 2 areas that I'm looking at. The euro versus US dollar and the won.
All right, so interesting stuff there. As we move to the upside for this week, listeners, a lot of things lighting it up to the upside, including a lot of the products we were just talking about in the world of all things energy out here. Let's do a top 7 or 8. Why don't we list it? Because some fun going on here, including at the bottom of our list out here this week, Bitcoin futures. I just want to point that out because I know a lot of our crypto holders out there are looking for a little bit of upside. You got a little bit of upside this week. So far, this conflict in the Middle East has been a little bit of a boon to the crypto space. We're seeing a lift kind of across the board. ETH, Bitcoin, Solana, all the major crypto assets catching a bid this week. And the Bitcoin micro and big futures taking the number 8 spot this week, up about 6.3%. So again, a long way to go to make back what they've lost so far over the past 6 months, but you'll take anything you can get out there at this point. The reason I expanded it beyond our top 5 this week, listeners, is a couple of interesting names slotting in here, including coming in at number 7 this week, is a product we don't talk about a lot, or an index really we don't talk about a lot. It's the S&P GSCI. What is that? It used to be known as the Goldman Sachs Commodity Index, but that is sneaking in this week. Again, shows you what a tumultuous week it is out there in the world of futures and indeed commodities, up about 6.75% for the number 7 spot on our list. Number 6, kind of a bit of an obvious one. If you see what's going on out here, there are really 2 narratives that a lot of people are fixating on this week. Obviously, one of them is all things energy and crude. The other side is the vol, the impact of this conflict on volatility. We saw VIX cash spike to nearly a 30 handle yesterday, a retreat off of that today. The futures getting up to about a 25 handle before they retreated. But obviously S&P, the VIX is still hot right now. Coming into the start of the show, it's up about 7.25% out there on the week. And then we get into our top 5 for the week, listeners. It's OJ, number 5 this week, up nearly 9%. OJ's had a rough year and a half, getting some back out here this week, up about 9%. And then the rest of it is all energy all the time, listeners, for obvious reasons. Number 4, it's our old pal RBOB, up 12.3%. Number 3, WTI, up 14.33%. Number 2, the international flavor of crude, yeah, it's Brent, 15.25%. And the big dog, as Brian was alluding to earlier, heating oil, having itself quite the week, up nearly 30%, 28.75%. Brian, we just did a deep dive into all things energy, but some of these numbers really do just leap off the page here. In particular, the heating oil. Anything else you want to add on any of these products out here, sir?
Well, heating oil in particular, if you look at that versus RBOB versus gasoline, heating oil is something we've been identifying for the last 6 months. Most of the last 6 months, we were spending time between 2 and 230, and it's just fundamentally undervalued and broken at those levels. It needed to be higher. So I would see heating oil probably cooling off, maybe coming down to 3 from 330, where it is now. Because if you just look at the spread between gasoline and heating oil, it was holding at about 20 to 30 cents. It's now up over 80, or close to 80. So when you look at the spread between the two, it's a great spread trade. So when I look at gasoline and I look at distillate or heating oil, I see great compression trade to make there. And again, not a financial advisor, just two guys talking.
Yeah, nearly 30% in a week. I think anyone will definitely want to sit up and pay attention to that. We have a joke in our intro. What the heck is RBOB anyway? We might need to do a bit of a deep dive into the contract specs to explain what RBOB is in a little bit more detail, listeners, because it sounds like
it's refined,
yes,
blended, oxygenated. What's the last one? I forgot the last one. I can't remember it. It's not Brian, because I'm here. Reformulated blend stock for oxygenated blending. That's what it is.
Blending is the last B. There we go. That's what threw us off. The last B is for blending. Will it blend? Remember thoose old videos back in the day, Brian? But looks like RBOB is definitely blending out here this week, listeners. And again, another product, maybe a bit of a surprise one to keep an eye on here this week. Everyone's fixated on all things crude and nat gas, but maybe a little bit of RBOB sneaking in to your portfolio out here this week. Let's see what's sneaking in to our most actives today. And we're only going to do a top 10 because we're already kind of coming up against it. And we've had a lot of fun on the show already. And B, I think you'll find some surprises in the top 10 today, which again shows you kind of what a wild week it is. It's not all equities and rates all the time. Number 10, it already cost you 507,000 contracts to break into the top 10 today. That shows you what an active day it was. And that was just at the start of the show. I'm sure it's even hotter now. That gets us to our old pal, the NASDAQ E-mini. Number 9 is kind of the surprise entrant in our top 10 this week. And again, it shows you how hot the energy markets are when crude can break into the top 10 and come in at number 9 with 538,000 contracts. That is a pretty hefty amount of volume. Number 8, the Ultra 10-year, 577,000. Number 7, 3 months SOFR, 661,000. Number 6, keeping it in the rates with the 2-year, 809,000 contracts. Number 5, to the equities we go. The S&P E-mini, 1.2 million. We're only at number 5. We're already north of 1 million, so it's a pretty hefty day, listeners. Number 4, the 5-year note, 1.27 million. Number 3, the S&P Micro, 1.54 million. Number 2, yes, I said number 2. It's the 10-year, 1.85 million. That means, the only product that can really usurp it most days, it's the NASDAQ Micro, 1.98, almost 2 million contracts. Again, it's a micro. Take that volume with a grain of salt, but obviously a spicy day. Brian, one of the barometers we have for when a complex is starting to light it up is when it can break into the top 10 and kick some of the old stalwarts of the equities and the race to the curb. And WTI doing that today, sir. So definitely delivering on the volume front today and indeed this week, Brian.
Yeah, definitely. And, here's the thing is that a lot of times I identify price levels. And we're in a holding pattern. Obviously, there was a big shock over the weekend. And after jumping up to 75, dropping back to 71 and jumping back up to 76. If we break above 76, we are headed to the 80s. But as I said before, my projection is that we're kind of at a ceiling without incremental news or disruption. So, like I said, we haven't seen disruption, we've seen stalling. In other words, crude is being stored, it's produced. Now, Iraq is starting to shut in production about 1.5 million barrels a day, just because it didn't have enough boats to pick up. And that has to do with the strait reducing the flows of ships through there. And if you ever want to spend some time understanding it, there's a great website called marinetraffic.com, and you can zero in on the Strait of Hormuz and actually see what's going through there.
Let's see what's lighting it up so far for the year. What trends are developing? Obviously, we've been talking a lot about metals so far this year. Equities have been a point of contention. Large caps versus small caps. We've seen some action in soybeans, some of the other products out there. Right now, all the focus is on the energy. So let's go to the upside so far year to date. Let's actually make it a top 6 because RBOB just slides in at number 6 for the year. It is up about 28% so far for the year. It's up about 28.6% into our actual top 5. It's soybean oil again. Soybeans have been hot for a little bit. The on again, off again China trade is on again, at least for right now. Soybean oil up 29.3%. Number 4, back to our old pal WTI, obviously getting a nice lift, up 31% so far year to date. Number 3, to the land of dairy we go. It's non-fat dry milk, up 32.6%. Number 2, it's Brent, up 35%. And the big dog, again, as we're talking about our old pal out here, we're talking about heating oil, up 57.3%. So RBOB coming in at number 6, up 28.6%. And then we got our old pal, actually, heating oil, up 57.3%. So actually, just wild stuff. I'm not sure how much more we can say about the energy products this week, Brian, other than the fact that they are just dominating the tape.
They are dominating the tape. And so one thing when we talk about crude oil, it's part of the reason that we break down fundamentals is when you're talking about demand on crude oil, a lot of people stop at the refinery. The demand is really on the other side. It's part of the reason that when you look at crude oil, heating oil, and gasoline or RBOB, when you look at those three, that is going to tell you the triangulation of the direction of the energy markets because you have the upstream side, which is the crude oil, and the downstream side, which is going to be motor gasoline and distillates or diesel. Now, when you look at what it is used for, a lot of the distillates or heating oil is in a very good fundamental place, meaning stocks are low globally. That means that there is less supply held back to be utilized. Motor gasoline, on the other side, is topping out. It is way above historical averages. So when you look at that mix, it creates a bearish fundamental view on gasoline versus heating oil. But at the end of the day, we're still going to be running crude oil through. What type of products are we going to get back out on the other side? And this gets into the interesting game of how long this event can happen before there's real problems or disruptions. And you'll see this at gasoline stations over the last week have already probably increased by 10%. Jet prices, like some airfares, has already jumped over 20%. So this is going to translate to a lot of economic inflationary events very quickly because distillates and diesel is going to impact everything that you buy and order online and everything that you create because that is all the trucks. So all the trucks that deliver the stuff and marine bunker fuel as well. It is going to increase the demand on marine bunker fuel and diesel. And as a result, I don't see much bullish pressure declining on the heating oil side. But on the gasoline side, I see that's where consumers will restrict their consumption. And we're already in a very comfortable place on the supply side.
All right, let's see if we're in a comfortable place to the downside. Probably not, listeners, unless you're heavily short. Number 5 for the year, listeners. Like we said, nat gas kind of playing out like clockwork so far this year, and it's still off 7.5% a year to date, even with everything going on that we just discussed in the show. Number 4, we've got coffee. This will come as welcome news to all the Starbucks fans out there. Still has a long way to go, but it's off a little over 14% a year to date, so getting some back from those astronomical levels that coffee's been hanging out at for a while. Number 3, to the dark side. Again, not welcome news for the hodlers. It's Bitcoin, the large and the micro futures off about 16 2/3% year to date. The ones who are even less happy are, of course, the Ether fans out there. Ether, big and micro futures off nearly 28% year to date. It's been a rough start to the year across the board in crypto, but ETH really taking it pretty hard. And then the big loser once again on the year, it's our old pal Coco, off nearly 50%, 49.85%. So absolutely rough stuff out there for the Coco fans. All right, Brian, that music means we have come to the end of a wild sojourn through the world of futures this week. I appreciate you joining us to give us a little bit of insight, a little bit of a deep dive into what is certainly the hot complex right now in the world of futures. But before we go, if there's anything else you want to add, anything else we haven't hit on the energy side, feel free to share it with our folks. And if our folks are intrigued, they want to check out what you folks are up to over there at Energy Rogue, where should they go? What should they do?
Yep. The key is to go to energyrogue.com, not Rouge, Rogue, Rogue. But if you go there, I would say that I've done futures trading. I've done independent trading for myself, as well as large institutions like Chevron, Sumitomo, Louis Dreyfus. And one thing is clear on all the institutional traders that trade and make millions, if not billions of dollars on futures markets on energy, is understanding the physical disposition of the market gives you a routing. For example, that's part of the reason that we were able to stay ahead of the heating oil amplification when we went from 250 to 330. So that's a massive move, but we've been watching this for the last 6 months and positioning that way. So understanding the physical along with the financial, because everybody can read the technicals, it's important to understand what is underlying that position, because if you don't have a good fundamental position, then it's a house of cards and it's going to come down. And when it comes down, it's going to come down quick. So go to energyrogue.com. My name is Brian. Feel free to reach out to me. We do have a YouTube channel. Just go to Energy Rogue and you'll find us.
There you go, energyrogue.com. I want to invest in energyrouge.com as well for all the French folks out there and all the folks who can't type. There you go. Get both URLs while you're at it. But check it out if you have questions about this complex right now. And who doesn't? Check them out over there at Energy Rogue. And of course, while you're checking things out online, check out our friends over there at Tasty Trade, tastytrade.com/podcast. They do offer futures over there as well for a lot of the listeners of this show. So check them out, tastytrade.com/podcast. See what deals they have in store for you. That's going to do it for us on the Futures Rundown this week. Not going to do it for us on the network. We'll be back after the closing bell to break down another wild day out there in the world of options with the Hot Options Report. Then we're back again tomorrow with the Option Block and very much the sister program of this one, This Week in Futures Options. If you're listening to this show, you should be listening to This Week in Futures Options. Yet another reason why you should be subscribed to the full network. Then we're back with all the rest of our content throughout the rest of this week and next week till we're back again next Wednesday, another episode of the Futures Rundown. Stay safe out there, everybody.
Old trading walks into a bar. New trading raises it. That's Tasty Trade. Keep focused with news feeds that matter. See opportunity differently in analysis mode. Chart your heart out with over 300 indicators. Plus, you can get low pricing, lots of education, and a support team that really gets how traders trade. It's no wonder Investopedia named Tasty Trade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/podcasts and see for yourself. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.